While the crypto crowd was staring at price charts last week, a document surfaced that almost nobody is talking about, and the organization behind it processes more money every single year than most people can comprehend. $2.5 quadrillion every year. That is the annual transaction volume of the DTCC, the Depository Trust and Clearing Corporation, the entity responsible for clearing and settling every stock trade, every bond transaction, every securities movement across the United States financial system, the invisible backbone of Wall Street, the institution that most retail investors have never heard of, but that touches every dollar they have ever invested in the traditional market. And that institution just filed a patent describing a completely new financial architecture built on distributed ledger technology. A patent describing tokenized assets moving across blockchain networks with automated liquidity provisioning at a scale that dwarfs anything the crypto industry has ever processed. And inside that patent, in the bridge routing diagram that describes how value moves between networks in this new system, two blockchain networks appear by name: XRP and Stellar. Not Bitcoin, not Ethereum, not the most talked about chains in crypto media. The two networks specifically engineered for fast, cheap, institutional-grade value transfer. The world missed the signal. You are not going to miss it today. Welcome back. I'm the calm analyst. No hype, no speculation, just the architecture that is already documented, already filed, and already pending approval. Let's go deep. Let's start with the hard truth that most people in this space consistently get wrong about how the traditional financial system actually works. Retail investors think about finance the way they see it on the surface. Stock prices go up or down, interest rates move, a company reports earnings. What retail investors almost never think about is what happens after a trade is executed: the clearing, the settlement, the movement of actual value between counterparties. The infrastructure that makes sure that when you buy a share of stock, the seller actually receives the money and you actually receive the asset, reliably, every time, at scale. That infrastructure is the DTCC, and it has been running, largely unchanged in its fundamental architecture, for decades. Settlement in the United States moved from T+5 to T+2 to T+1 recently. But even T+1 means a trade executed today does not fully settle until tomorrow. Counterparty risk exists in that window. Capital gets locked up in that window. Friction accumulates in that window. Costs build in that window. And across $2.5 quadrillion in annual transaction volume, the cost of that friction is not small. It is systemic. Now, here's what most people do not understand about why the DTCC filed this patent. They are not experimenting with blockchain because it is trendy. They are not exploring distributed ledger technology out of curiosity. The DTCC has already stated publicly that their aspiration is to tokenize all $100 trillion of assets they currently hold in custody. They have already received their regulatory no-action letter, meaning approval to proceed. They have already said they are partnering with multiple Layer 1 blockchains to allow assets to move freely across networks. This patent is not a proposal. It is the blueprint for what they have already decided to build. And the blueprint names XRP. Let me show you exactly what this patent describes, because the architecture it lays out is unlike anything currently operating in traditional finance, and understanding it is the key to understanding why the specific networks it names matter so much. The patent is titled Systems and Methods for Managing Digital Liquidity Tokens. What it describes is a complete redesign of how financial markets provide liquidity. Right now, market liquidity in traditional finance is managed by human market makers, firms that post bids and offers and stand ready to buy or sell assets at quoted prices. That system works, but it is slow, expensive, and subject to the decisions of human intermediaries who pull liquidity exactly when markets need it most: during stress events, during volatility, during the moments when liquidity matters most. What the DTCC patent describes is an automated liquidity system applied to the entire traditional financial market. Think of how automated market makers function in DeFi. Smart contracts that algorithmically provide liquidity based on mathematical formulas, available 24 hours a day, 7 days a week, without human intermediaries making discretionary decisions about whether to pull their quotes. Now apply that concept not to a single DeFi protocol, but to the entire US securities market. Stocks, bonds, ETFs, commodities, funds, all tokenized and trading on distributed ledger infrastructure with automated liquidity provisioning at every node. That is what this patent is building. And here's the critical piece. When assets are tokenized and need to move between different blockchain networks, because no single chain can handle the full volume of 2.5 quadrillion in annual transactions, the system needs bridge infrastructure, interoperability, networks that specialize in moving value between chains quickly, cheaply, and reliably. The patent's routing diagram shows exactly which networks fill that role. User A node on Stellar's system, User B node on Ripple's system, two bridge networks, two value transfer specialists. Named explicitly in the architecture of the most important financial infrastructure patent filed in the last decade. Now let's do the math that the crowd consistently ignores, because the numbers here are not theoretical and they are not small. The DTCC processes $2.5 quadrillion in annual transaction volume. Let's put that in context. The entire global cryptocurrency market cap as of today sits at approximately $3 trillion. The DTCC processes that amount in roughly 11 hours of normal operations. The scale differential between where the crypto market sits today and the infrastructure the DTCC is being built to handle is not a factor of 10. It is not a factor of 100. It is a factor that most retail investors do not have a frame of reference for. Now think about what routing even a fraction of that volume through bridge infrastructure requires from the asset serving that function. XRP has 100 billion tokens in total fixed supply. Approximately 55 to 57 billion are in current circulation. The rest sits in escrow, releasing at 1 billion per month, with the majority relocked. The liquid, tradable supply is not expanding meaningfully. It is effectively fixed. Now here's the design math that the patent makes structurally inevitable. In a bridge liquidity system, the bridge asset needs to be present in sufficient quantity at every corridor to facilitate instant value transfer. But here's the elegant engineering reality. A higher price for the bridge asset means you need fewer tokens to service the same dollar value of transfer. To route $1 billion through an XRP bridge corridor at $2 per token, you need 500 million XRP as working float. At $20, you need 50 million. At $200, you need 5 million. The math runs in one direction. As the volume flowing through the bridge infrastructure grows, and 2.5 quadrillion in annual DTCC volume represents demand that dwarfs anything currently in the crypto market, the design requirement for the bridge asset adjusts upward, not downward. This is not a prediction. It is an engineering requirement baked into the architecture of the system being built. Cross-border payments alone process $150 trillion annually. The Forex market moves $7.5 trillion every single day. The derivatives market represents $1.2 quadrillion in notional value. The DTCC alone handles 2.5 quadrillion per year. Add those markets together, and you are looking at a volume of financial activity that requires bridge infrastructure operating at a scale that has no historical precedent in the crypto industry. If you have a problem with where that math points, you do not have a problem with me. You have a problem with arithmetic. Now let's stack the institutional evidence, because the DTCC patent does not exist in isolation. It is one node in a network of signals that have been quietly assembling for years. The patent filing history itself tells a story. Filed originally and assigned to the DTCC, then assigned to Securency, a firm working directly with Ripple, then published approximately 1 year ago, currently pending approval. The chain of custody for this patent runs directly through the Ripple ecosystem. That is not coincidence. That is documented institutional alignment. The DTCC has already added Hidden Road Partners, a firm Ripple acquired, to its back-end infrastructure. That acquisition did not happen speculatively. Ripple acquired Hidden Road because it needed the institutional connectivity that Hidden Road brought: prime brokerage relationships, clearing infrastructure, the legal and compliance apparatus required to operate inside the traditional financial system at scale. That connectivity is now live inside the DTCC's network. Securency, the firm that held the patent before its current status, was subsequently acquired by the DTCC itself. Let that sink in. The DTCC acquired a firm that was a Ripple partner and that held this specific patent. The DTCC now owns both the patent and the firm that bridged Ripple into the architecture. The dots are not separated. They are connected. The Royal Bank of Canada, one of the most systemically important banks in North America, is documented as one of 7 core governance banks in Ripple's network, alongside Bank of America, Bank of Tokyo Mitsubishi, Santander, Standard Chartered, CIBC, and Westpac. 7 banks, 5 continents, 1 infrastructure network. Franklin Templeton, Fidelity, and S&P Global executives have all gone on record saying most liquid assets will find their way on-chain, and that the total addressable market for tokenization could reach $1.5 quadrillion. These are not crypto advocates. These are the people who manage the money. And when the people who manage the money say everything is moving on-chain, the next question is not whether, it is which rails carry the flow. The DTCC's patent just answered that question for the settlement layer. Now let me address why Stellar appears alongside XRP in this patent, because I think the instinct to see this as competition misses the more important point entirely. Stellar's presence in this architecture is not a threat to XRP's position. It is confirmation of the thesis. Here is why. The DTCC has already stated publicly that it is impossible for one chain to handle the full volume of their operations. They said it at a conference. They made a video about it. One chain cannot rule it all. Not because any individual chain is insufficient in isolation, but because the volume, the regulatory requirements, and the diversity of asset types being tokenized require a multi-chain architecture with specialized networks filling specialized roles. Stellar focuses heavily on tokenized assets, stablecoins, payment infrastructure, and global remittances. Its architecture makes it straightforward for institutions to issue digital representations of real-world assets. That specialization makes it a natural fit for the asset issuance side of the tokenization equation. XRP was designed specifically for financial settlement, for being the bridge that moves value between systems, between currencies, between chains. 1,500 transactions per second, 3 to 5 second finality, transaction costs measured in fractions of a cent. That specialization makes it the natural fit for the liquidity and settlement side of the tokenization equation. These are not competing roles. They are complementary roles in the same architecture. And the DTCC patent, by naming both networks in the same bridge routing diagram, is not saying one will win and one will lose. It is saying both are components of the system being built. The question was never which chain wins. The question has always been which chains become the rails of the new financial system. And according to the most important infrastructure patent filed in this space, we now have at least 2 of the answers. Here is what I want you to understand about the timing of this moment, because the gap between where the patent stands today and where it is going is the window that matters. The patent status is currently pending approval, not filed, not an early review, pending approval. That means the examination is substantially complete. The prior art has been reviewed. The claims have been assessed. What remains is the final administrative step before this architecture receives its intellectual property protection, and the institution behind it can deploy it with full legal backing. Once that approval arrives, the DTCC has everything it needs to begin onboarding participants to the tokenized asset infrastructure described in the patent. Participants who, in the DTCC's own words, can reach out and ask for their assets to be tokenized and deposited into the wallet of their choice. Participants who include every major financial institution operating in the U.S. securities market. The collateral app chain the DTCC described, allowing collateral to move across the world at the speed of the network, releases capital that is currently frozen in pre-funding buffers. An estimated $27 trillion sits idle in Nostro and Vostro accounts globally, doing nothing productive, existing solely to buffer the friction of slow settlement. When that capital gets unlocked by instant settlement infrastructure, it does not sit in a savings account. It deploys into markets, into assets, into the digital infrastructure that liberated it. The regulatory environment has shifted in parallel. The OCC, the Fed, and the FDIC have jointly cleared U.S. banks to hold tokenized securities on their balance sheets with zero regulatory penalty. The legal barrier that kept institutional compliance officers from signing off on blockchain participation has been removed. The capital that was waiting, cautiously, professionally, with full intent to deploy, now has permission to move. The DTCC's tokenization service launches in the second half of this year. The patent approval is pending. The regulatory gates are open. The institutional partnerships are confirmed. The bridge networks are named. The fuse is not being lit. The fuse is already lit. What you are watching right now is the burn moving toward the charge. I want to talk directly to the people watching this, who have been in this space for a long time, who bought the thesis years ago, who have watched cycle after cycle of promises and narratives and catalysts that moved the price for a few weeks and then faded. I understand the fatigue. I understand the frustration of watching a price that does not reflect the infrastructure being built around it. That disconnect is real. The gap between what the DTCC patent represents and what the current price of XRP reflects is real. But here is what I need you to understand about that gap. It is not evidence that the thesis is wrong. It is evidence that the market has not yet processed the architecture. Retail investors are watching price charts. The DTCC is filing patents. Those two groups are not looking at the same information on the same timeline. And historically, in every major asset class, the moment when institutional infrastructure is being built quietly while retail sentiment is frustrated and skeptical is precisely the moment that separates the people who hold through to the realization from the people who sell into that realization. Being early feels exactly like being wrong, right up until the moment it doesn't. The crowd is not reading patent filings. The crowd is not connecting securrency to the DTCC, to Hidden Road, to the Ripple governance banks, to the central bank tokenization pilots happening simultaneously. The crowd is looking at a chart and feeling the emotion of a price that has not moved the way they expected. You just read the patent. You are not the crowd. Here is what I want you to carry forward from everything we covered today. The DTCC processes $2.5 quadrillion annually. They have filed a patent describing tokenized assets, automated liquidity provisioning, and cross-chain bridge infrastructure. Inside that patent's routing architecture, two networks are named, XRP and Stellar. The patent has passed through Securrency, a Ripple partner, and is currently pending final approval. Hidden Road, acquired by Ripple, is already integrated into DTCC backend infrastructure. 7 of the world's most systemically important banks are in Ripple's governance network. The regulatory gates for institutional blockchain participation have been opened by joint action from the OCC, Fed, and FDIC. The DTCC's tokenization service goes live in the second half of this year. Every one of those statements is documented. Every one is verifiable. None of it is speculation about what might happen someday. This is infrastructure that is being built, confirmed, and deployed in a timeline that is measured in months, not years. The real question is not whether the traditional financial system moves onto blockchain rails. The DTCC, Franklin Templeton, Fidelity, S&P Global, the Bank of Canada, and the Royal Bank of Canada have already answered that question. The real question, the only question that matters for where you are when this transition becomes obvious to everyone, is which networks carry the flow. According to the most important institutional patent filed in this space, the bridge runs through XRP. Comment patent below if you made it all the way through this analysis. I want to see who is reading the blueprints and not just the price ticker. Stay patient, stay rational. The architecture is already drawn. The rails are already named. The capital is already waiting at the gate. We don't wait for the future. We plan for it.